Good afternoon, everyone. I hope everyone is in good spirits today. I just want to check that I'm unmuted. I am. Afternoon, everyone. Hope everyone is in good spirits. Just looking at the name of this event and sort of remembering how we came up with the word Fireside back in winter and how that seemed like a good idea. I think you'll see Walt with his jersey on at the moment. He's obviously sitting in a different territory where it's a lot colder than it is here. So just to kick off with a little bit of admin, I think we're going to run our chat for around 30 to 40 minutes. We're then going to tackle some of the questions that you have sent through in the invites. We also encourage you guys to use the chat functionality within Teams to ask further questions. Our guests have been waiting all week for an opportunity to answer them. There will be a recording available for those that might have to pop in and out of the call. We'll send this out to all attendees, so please pop us a mail if you haven't received by next week. Also, I think we need to mention that our analyst team sits within Global Markets, and we will express our independent opinions on this call. So, some of these opinions might differ a little bit from the Nedbank House view. So let's get down to it. I think we're in for a real treat today. We've rounded up two of our more experienced members. I think in the invite it said old hands, but maybe experienced is a better way of putting it. The handsome youngster on your screen you see is Neels Heyneke. You'll be amazed to know that this face has over 35 years of experience in financial markets. Neels started off trading bonds before seeing the light and hopping across to what I think is a more exciting world of research. I think I've lost count of the number of awards that he's received over his 35 years, but he's been rated in technical analysis, he's been rated in innovative research, fixed income, and investment strategy. And I think most importantly, for those that know Neels, he's never lost his intense passion for markets. We've also got Walter de Wet on the call with us today. And unsurprisingly, I think Walter is slightly less experienced than Neels, but he is just as accomplished. He started off covering the commodity space before transitioning into macro strategy. And it is in this capacity that he joined Nedbank back in 2017. Walt's been the top-rated FX and fixed income strategist in South Africa in recent years. And he also produces our quarterly outlook document, which brings together the views of all our analysts. So for anyone looking for a succinct overview of our asset allocation thoughts, please give this document a read. So let's kick off immediately. The question I think we posed is inflation or deflation. And the first piece of advice I think I got when I started off covering sectors is that you start with your conclusion up front. So let's start with that conclusion. Neels, I'm going to go to you first. Inflation or deflation?
Sorry, I don't know if it's my phone or you coming through broken, but I assume you asked me if I'm going to believe if there's going to be inflation or deflation. We are entering a deflationary world. We are following Japan and the rest of the world. And my view is deflation.
Nice and clear. Thanks, Neels. Walt, can you hear me clearly?
Yeah, I can hear you clearly, Avi. Thanks so much. Good afternoon. Thanks for the introduction. Yeah, if you ask me South Africa, South Africa specifically, obviously what I look at, I would have to say inflation. If I talk around DM, as Neels has mentioned, I would agree with him, generally deflation.
Okay, so at least we've got slightly differing views here. I think we're generally on consensus on the DM deflation environment, but we're going to unpack that in further detail. So Neels, let's start with you. I think there's probably two ways of looking at inflation, one from the supply side and probably one from the demand side. So let's kick off with you. From the supply side, what causes inflation? What sort of work have you done around this trend?
All right, so obviously, yes, good afternoon to everyone. Very rude of me not to say hello, and thank you for joining us. So yes, if we take a little bit of a monetarist view on it, and I have a bit of a Austrian School of Economics streak in me, money supply is always the cause of inflation and deflation. And to say just where deflation or inflation is coming from, I just want to grab the opportunity and take the guys a little bit back in history, and I promise it's not going to be a history lesson, but the world's been struggling with inflationary and deflationary cycles for 800 years, and there's data on, and that's what the Reinhard Rogov book was about. But so that's why we created central banks, to get away from this very volatile inflation and deflation cycles, because traditionally every 23 years the credit cycle will blow up completely, and we will have massive deflations, and governments will debase money, and they will create inflation, and was unfortunately also politically very unstable there in the world. But because we entered the world of central banking 100 years ago, and we've had a 100-year cycle of inflation, and inflation is ingrained in society, and we think in terms of inflation. Inflation, in my opinion, and deflation always come from the expansion or the contraction in total money supply. And there, I just want to point out two common misconceptions people have about inflation and deflation. Inflation does not come from the change in the monetary base. It comes from the change in the total pool of money supply, meaning base and or credit in the system. And also inflation doesn't come from the inflation basket. That is just how we measure inflation. It comes, as I say, from the supply side, from the of money and credit into the system.
Thanks for that, Neels. I think you've opened up a lot of different points that we're going to chat about further, but let me just give Walter a bit of a chance here to give us his views.
Yeah, thanks, Harvey. Yeah, look, I mean, if we talk about the developed markets, for me, I look at it slightly different than Neels and I. We talk about these things endlessly. For me, it's almost purely a demand-supply function. And money supply might play a role in it, determining demand. But if you look at all the cycles over the years, and especially if you go back, the past century, where number one, as Neels has mentioned, central banks have started to come into the general flow of economics. At the same time, where the world population has just exploded, and we know that world population since the early 1900s started to grow substantially, while generally supply has been lagging. And we've had demand generally exceeding supply. And that is why, as a world, we're kind of used to inflation, and especially in the 50s, 60s, and especially, I guess, the 70s. But we're at the point now where in DM specifically, you sit with population growth declining. If you think about Europe, many of the Asian economies, China, for example, Japan, where demand is just slowing naturally. And that should be deflationary. On top of that, you've got a credit cycle, as Neels has mentioned, which can expand still more, but the marginal demand that it creates is very little. But I do think that is completely opposite to what we're seeing in many emerging markets, in South Africa specifically. And that's one of the reasons why I think, if you talk about South Africa specifically, demographics still favors inflation, and in generally the supply side as well.
So maybe if I go back to Neels, I mean, I think we have consensus that developed markets will experience a deflationary environment for a while longer. Why is this a concern for you, Neels?
Well, in a credit-based world that we live in currently, with the whole experiment of central banking that started 100 years ago, and the world is driven by credit. So once you start, and it's got a positive feedback loop on the system, so the more credit you create, the more it boosts the economy. And people think inflation always just ends with the price of bread. It's also the price of assets that go up with it. So as the credit expands, it pulls up asset prices, and that allows more credit into the system. And that keeps the whole system alive. So the moment you have a slowdown in the credit creation process, that causes deflation, and the asset starts falling, and you have all this debt in the system, we start getting into balance sheet problems. If you own, the old story, if you owe the bank $1 million, the bank's got a problem. If I owe the bank $1 billion, the bank's got a problem. So if everybody starts owing the banks a lot of money and their balance sheet starts getting into trouble, then the whole system is in trouble. So just to give you two numbers on that, the world's GDP is, well, it was 85, 86 trillion before COVID. Is going to be a little bit smaller now, but so it's in the mid-80s. But the total pool of credit in the world is in excess of 400 trillion. So the world is 5 times geared. So the last thing we can need is if unfortunately asset prices starts contracting because you have a deflationary environment. So that is my major concern.
And I suppose if we carry on from that, I mean, if you just look at it from a political point of view, I mean, deflation doesn't seem to be the right method for governments at the moment, and they probably want inflation. So how do we get inflation back into the system in this environment, Neels?
Well, first of all, you've got to try and get rid of this debt. Now, so there are 3 ways to get rid of the debt. You can let it default, and that's unfortunately what happened in 1929. The stock market crash was not directly the cause of the depression, but it was indirectly because it created problems at the banks on their balance sheets, and then the US took a decision. Well, the banks took the risk to write these loans, they didn't take the loss. And then unfortunately, the losses were so big in the American banking system, it completely collapsed and most of the banks closed down. It was a massive deflation process. So I don't think we'll ever go down that road again. The second one is you grow out of it. And that's what we've been trying to do, and central banks have been cutting rates very aggressive. This that we grow out of it with, as you see, how fragmented the global politics is becoming right now. And then the last one is you debase, and that is currently happening, and that is people's major concern. Just the statement I want to make around this debasement, it's far more difficult in the developed world with very developed financial systems to debase the world, because you've got this constant war between a contraction in the total money supply and credit, and this boosting of the monetary base. Japan has been trying it for 30 years, and they're still not successful. Japan's balance sheet is now 123% of the GDP, and they still don't have inflation. But I think the debasement of money is the way the central banks will go. I must just on that point stress to all the viewers, it is not a South African problem in the South African Reserve Bank. We are very fortunate to have a wonderful organization that is very concerned about the price of money to protect the citizens of the country. So I am not referring to the South African Reserve Bank here.
I think you mentioned Japan in that as well, and I think we're going to get back to that a bit because I think there are a lot of lessons that you've taken from it and are thinking about that in a developable market. But just to shift across to Walt now, Walt, you mentioned the emerging market versus developed market differential, and maybe go into a bit of detail on why you think inflation is going to happen in emerging markets and not so in developed.
Yeah, so look, I mean, it's obviously not all emerging markets, but emerging markets in general. And as I've mentioned, I think the first function that plays, or the first variable that really plays into inflation for emerging markets in general, South Africa specifically, is, as I've mentioned, demographics. Generally speaking, young populations, that's coming through. You will continue to see demand grow from a very low base in these economies. The second thing that plays towards inflation, which is to some extent different from many developed markets, is you don't have the big supply base in many of these economies. South Africa being the most industrialized economy in Africa, is still lacking in supply, and we know the capacity constraints in general. Now, in many other, which obviously creates inflation and pressure on prices. And we know in general in other EMs, this is a substantially worse problem, which also plays towards prices. And then the third reason, is linked to the previous point that I've made, is the fact that you sit with structurally in many administered prices in EM continues to push upward pressure on prices. You just need to think about water, for example, electricity, for example, in the case of South Africa, and it's not unique to South Africa. You just need to think about the pressure on the tax base that comes through in, for example, the cost of housing and municipal taxes, etc. All of these things continue to put upward pressure, and generally you see the supply side passing that on to the consumer, and ultimately it starts showing up in local prices. And then the last function is, in general, you sit with EM, which, and there are exceptions. China, of course, is one of them in some of your Asian economies. But to a large extent, EM in general need to import quite a lot of goods and services. And with EM currencies, as we've experienced lately under pressure, these things tend to also create inflation in certain environments where import prices tend to rise as the exchange rate depreciate. So overall, while you might have periods of lower inflation, I think you are stuck in a world which is not necessarily bad, where inflation will be positive as opposed to negative.
I suppose, just the one thing that you mentioned is around population, and population growth undoubtedly higher in emerging markets than it is in developed markets. But how do you think about working age population? I mean, that's something that's obviously under pressure in South Africa. Jobs are under pressure. Is this just a short term? We're going to be under pressure from a working age population that's going to lead to lower inflation, or is that something that comes into your thinking sort of over the medium term?
Yeah, so look, I mean, I think it's more a medium-term thing. I think if you think about short-term, 12 months to maybe 2 years, I don't think really that is a major factor playing into what's going to happen in inflation. But if you talk 5 to 10 years, certainly it does. But I actually think if you've got a working population coming through, that should also be inflationary. Because ideally, you've got more people entering the workforce. If you don't have a 10% contraction like South Africa has had this year or gonna have this year, but that overall continues to create demand. So I think it's the same type of story. Population growth and working population growth still leads generally to higher inflation, higher demand overall. Just on that point, you two, it is in the report I put out this morning on inflation, deflation. One country that is unfortunately an emerging market that is very exposed to that is China. Their one-child policy is coming back to haunt them. They have got quite an aging population that's going to age very quickly, and they sit actually with a lot of bank debt. Their banking debt is now 4 times their GDP.
Sure. Wow. And I guess, I think, Neels, we've chatted about this before, but the generational difference between the older people that are retiring and then some of the younger population, and given the debt levels that we see at the moment, like just on a holistic point of view, how does the current generation of 25 to 40-year-olds operate in this type of environment? What does it mean for them?
Yes, well, they're still better off than myself that needs to retire soon, and there's a 0 interest rate environment to retire. It's actually worse for the baby boomers, but they had the benefit of it over the last 30 years of the asset growth that I do not expect asset growth. It's all been already quite stagnant since the financial crisis. If you strip out the tech stocks, there's been literally no growth anywhere in the world. No asset is giving you any return. And that's actually the role I think the central banks are currently playing. They're trying to make sure that you don't have too much asset deflation, if I can put it in that way, that they want to keep the asset markets as stable as possible, that they can start addressing this excess debt in the system, that we can get it out of the system as quickly as possible, and that we can grow again, that the 25-year-olds can create jobs and wealth going forward.
Avi, and I've just Neels mentioned asset price inflation, and I was just thinking about it in the context of South Africa. and something where we as a team also discussed earlier this week. If you think about South Africa and asset price inflation generating wealth, South Africa now with interest rates so low as it is, and obviously the central bank trying to create inflation, naturally in that type of environment, that is asset prices tend to grow, and hard assets tend to grow quite well. I mean, we've seen it in the likes of North America, Europe, where house prices in general obviously go up. So it should actually be very favorable for the housing market in South Africa, and property in general, which obviously if people hold property, that their balance sheets expand, they become wealthier, at least from a balance sheet perspective, and it creates confidence. And that is definitely a positive which could go into South Africa's favor. If you take a 3 to 5 year view, one of the issues obviously to the detriment of that channel working in South Africa is the uncertainty in policy and I guess property rights. But if we can get that right, it's certainly an environment which favors asset prices in South Africa as well.
I suppose, I always bring up this topic, but if money coming in is flowing into assets, I mean, the assumption is that probably means higher levels of inequality in South Africa, and that those that have assets benefit more from it. Maybe I'll go to you, Neels. Is that something is that a trend that you agree with, or you see happening?
Yeah, no, it's something that I've been concerned about for many, many years. I've been writing about it for many years. It is not a South African problem. It is a global problem. But it's obviously a very intense problem in South Africa because of the history. And I think, and I can see the World Bank, the IMF, the BIS, the Federal Reserve, they're all starting to talk more and more about the inequality. So I know that the Federal Reserve is trying to deny that they're creating inequality, but they know they are creating inequality because every QE process, how it actually works is it compresses the term premium in the bond markets, compressing the discount factor, and then just you guys that do all your discounted cash flow models by pure design, the present value of assets go up. And unfortunately, this is where this top 1% theory, which is not a theory, it's fact, where the top 1%ers get all the gains, and unfortunately the working classes, because the money never reaches the economy, stay behind. And here's the problem with it. For 30 years now, assets have been outperforming the GDP. So if I give you R1 billion today, why would you invest it in the real economy if you're guaranteed you're going to make more money in the financial markets, and the central banks are going to give you a de facto bailout if something goes wrong? So they have to unfortunately address that. They can't just keep bailing out the financial assets. The social consequences is already quite big, and it's going to get bigger.
And Walt, from a South African perspective, is this something that policymakers think about?
Yeah, no, absolutely right. I mean, they definitely do. I mean, and the Reserve Bank talk a lot about this. And our governor has mentioned a couple of times that how high inflation is actually to the detriment of the poor. And I don't think necessarily only because it increases the skewness of income, but higher prices also tend to feed into stuff like food prices, etc., which we know the poor their consumption basket is bigger or skewed towards food, etc. And that is why why it's a fine balance between having too high inflation and having deflation, right? I mean, in the world where you've got too much debt, the last thing I think you want is deflation. But certainly, you don't want inflation of 10-15%, because that's going to result in exactly the negative effects which we've just discussed now. And it is also a bit of a catch-22, right? I mean, if you have low interest rates and you create inflation, which is the environment that's good for assets in general, then yes, I mean it favors your asset holders in the economy. And I guess that is a policy decision that the government needs to make, is whether they actually want to allow that and maybe kickstart the economy. Which ultimately also create jobs, right? Because you've got to remember, if property prices, etc., goes up, people start building more stuff, more houses, maybe not commercial property, but certainly the housing market takes up, whether it's renovation, whether it's new stuff. That creates jobs as well. That creates confidence in general over the economy. So I think one should not necessarily only look at this type of environment as negative. There's certainly a lot of positives too. But as Neels has mentioned, if you continue it for a period where that is too long, where interest rates in developed markets has been pretty much zero for 10 years, that does start to create issues in the long run. But if you run it for 2 to 3 years, certainly I don't think it's necessarily an issue.
Thanks, guys. And let's just shift a little bit into asset classes now. And I think the exchange rate is something that everyone's very interested in. How does the inflation deflation argument factor into your thinking around FX? Maybe I'll go to you, Neels, first.
Well, first of all, as you guys know, I've been writing about dollar liquidity for a number of years. Because as you know, the system developed in 1944, we started with signing of Bretton Woods, we started moving off the gold standard. By 1971, we closed the gold window and we went on to a fiat monetary system where money is just worth what we think it is worth. But the world was since then driven just by dollars, and it's the reserve currency. And then we signed the petrodollar system, the Americans and the Saudis. And all of a sudden, global trade became the dominant creator of liquidity. So that's a common mistake. People think that the Fed is in complete control of all the dollars in the world. It's not that simple. Dollar FX reserves are still a bigger number than the Fed's balance sheet, which is ginormous right now. So whenever we have a lot of global trade and the oil price goes up, we create a lot of dollars. By design, then the dollar comes under pressure because we've created a lot more dollars, and that works directly into the value of the rand. So we believe actually that global flows through the carry trade and whatever, global trade is 3 times bigger than trade flows where we import and export goods around the world and services. So we do believe that, yes, the monetary system, the way it is designed has become a major driver of currency. So in a bizarre way, global trade drives the value of the rand more than just the internal stuff. But obviously, this is what Walter will specialize in. It's not just the global factors. It's always a combination of global and local factors determining the value of the rand. So if I believe in deflation, by design, I have to believe that the total pool of dollars in the world is going to contract, and the value of the dollar has been in a bull market since 2011. I know it had a bit of a setback this year, but my long-term view I remain a dollar bull over the long-term horizon, and unfortunately, because of that, I believe the rand will remain under pressure.
So less, or a retreat in globalization equals less USD in the system. That shortage means higher USD. Walt, you've obviously got a more constructive view on the rand. How do you argue the point?
Yeah, so look, once again, I guess it depends what time horizon you take, right? As default, if you take a 10-year view, or even a 5-year view, you've got to know that the rand will depreciate against most developed market currencies, including the dollar, for the simple reason South Africa's inflation rate is higher than DM, and it doesn't hold over the short run, but certainly long term that is a key driver: inflation differentials and ultimately interest rate differentials. And so there I would also agree with Neels, right? I mean, and the dollar is obviously in a special situation where it's also the reserve currency of the world, and hence also its ties to trade. But if you look shorter term, yeah, absolutely, I have been quite constructive in the currency and continue to be. I still think that the rand will continue to strengthen generally. Most of the strength has already taken place, but there's probably still some left. And for me, that's not necessarily a deflation, inflation environment that we're in. It's mostly an undershoot, overshoot type of scenario, which we continue to see in EM assets. And we have seen this in EM assets, since the early 90s. Where typically in crises we've seen it in 96, 98. 2001 2009, 2016. We've seen it this year where, everybody goes to the dollar, as Neels has mentioned, when we've got a global scare, we've got liquidity contracting, and ultimately it normalizes for some while, and it goes back to a general trend, which I see as the inflation differential. And currently we think that value is closer to a 15 where it should normalize to. It doesn't happen overnight though, it takes time, typically a year or two to slightly longer. And we're about 8 months into that cycle now.
So short term, nice strengthening, but then in the medium to longer term, probably agree with Neil's view that the rand will weaken. Niels or Walt, maybe on your side, South Africa's got this obsession with inflation targeting, and we're obviously trying to stick as close as possible to the 4.5%, and we're tracking well below that. In this type of recession environment, is there any chance that central banks or our central bank will change tact on this?
So no, the short answer is no, and I would also think that they shouldn't. Inflation targeting at this point is probably the best tool that central banks, or at least central banks similar to South Africa, has to its disposal. 4.5, you can argue whether they should target 4.5 or 3.5 or maybe 5. But generally, all the economic literature and quantitative evidence shows that a stable inflation rate is not detrimental to growth, and in fact, it enhances growth. So that is really what South Africa wants. So I think it's a good policy. However, I think as we progress and big data becomes a bigger thing, and people are able to track information much quicker, I think different tools will become available to central banks, and which is similar in nature to inflation targeting, but I think probably creates a bit more stability. And some of these tools would be, for example, to target nominal GDP, which effectively if you think about the two components that's in nominal GDP. It's real GDP and inflation. You add those two together and you get your nominal GDP growth. And if South Africa, for example, target a nominal GDP of 7%, it would imply that they probably target real GDP of around about 3% and inflation of 4% gives you the 7%. And the benefit of that is that, especially from a fiscal situation where South Africa is in right now, where a lot of the tax revenue depends on nominal GDP and stability in that. If you can create some stability there, it implies that tax revenue is also more stable. And obviously that is also good for the fiscus and in terms of planning. I don't think technology and data allows for it yet, but I certainly think we're moving towards that in a multi-year view.
Oh, that's a fair argument. I think everyone's looking for a quick fix to the current scenario, and hopefully lower rates mean that, but agree, in the longer term, it's probably detrimental. Niels, I think we touched a little bit earlier around the USD being the reserve currency. Is there any chance that changes? And I'm going to throw the cryptocurrency in here a little bit. I have no idea what it means and how it works, but maybe just give us a little bit of background on your thoughts there.
Again, as Winston Churchill said, if you want to understand the future, you must know a little bit more about the history of things. The dollar is already the world's 7th attempt at a reserve currency. It's been the biggest and the most important so far of the 7. And the reason for it is that it's the first time in history that the reserve currency, that the world's debt is denominated in the reserve currency. Traditionally, debt was always denominated within each country and in its own currency. And ironically, the reserve currency always used to belong to the country with the biggest navy because they controlled the trade routes of the world. Yes, the dollar will come to an end as the world's reserve currency, as all previous reserve currencies came to an end. They last an average of 93 years. The first 50 years is the build-up of the empire. The second 50 years is the demise of the empire, and they all ended exactly the same way. They print money, debase the currency, and eventually they fall. It's from the Roman Empire. Nothing has changed until today. Nothing has changed. But I think that eventual fall of the dollar is much further away than most people think, because first of all, there is no alternative to the dollar. Japan is a proper old age home where they sell more baby nappy than adult nappies for the last 10 years. The Eurozone still doesn't have fiscal unity, so they still a long way off that. And China hasn't got an open capital account, they've got exchange controls, so they can't be a competitor either. And the biggest problem, in my opinion, is that the world's debt is denominated. Approximately 75% of all the debt in the world is dollar denominated. It's going to be very, very difficult to get rid of the dollar as a reserve currency. So the cryptocurrency, that was a sort of a public revolt of the youngsters, you 25-year-olds, against this debasement of money. But then something went wrong, unfortunately. Because, again, sorry for the history lesson, but money is used for accounting, store of value, and payment system. Now, if you want the store of value, it must be reasonably stable. And all of a sudden, crypto, which was a very good idea as a revolt against the debasement of money, became a speculating tool, and the value of the cryptocurrencies are all over the show the whole time, and that destroys that store of value argument. So I personally don't believe that we're going to go into a cryptocurrency system. Yes, I believe in electronic money, and all the central banks are going to issue digital currencies. But I do not believe that the cryptocurrencies will take over. Then we can rather go back on a gold standard, which I don't expect to happen anyway. But yes, I'm not a big supporter of cryptocurrencies.
Thanks for that, Niels. I think we're actually running out of a bit of time here, and we've got a lot of questions from the audience, which is a good thing. So I think I've got a few more, but a lot of them will tie into some of the questions. I think the first one is more a comment. Great insight from Niels. It's like watching the History Channel without the ad breaks. But the first question, let me go to here. Maybe I'll put this to Walt. What do you think the consensus view is at present on National Treasury pre-funding for the fiscal year?
Yeah. Good question. And we certainly think if pre-funding means raising the necessary financing to plug the deficit and where they sit relative to what they need to raise, we certainly believe that they've managed to do a good job and they're running ahead of schedule. And also, if you look at next year, we think that the funding requirement will also decline further. Not that the deficit will be substantially better, but just because this year has been so bad. Where's consensus? Good question. Well, by definition, I wouldn't know because we don't see all the competitors' stuff. But if you look at the bond market, I think certainly over the past couple of days, 2 or 3 days this week, I think there has been a general move shift towards people starting to think that there is probably room for Treasury to ease the demand on local savings, i.e. decrease auction sizes at some point. They will of course be conservative in that, but certainly all data points towards that. So I think consensus is moving towards there is room to decrease the funding requirement.
Okay. Thanks, Walt. Next question. So, and this I'll probably put through to Niels. So with regards to developed markets, what is the role of bond markets and bond investments in specific if rates are going negative? What's the point in investing in negative rates? So that's the first one. And then number 2 is, if money supply is a source of inflation, why are we not seeing inflation in the US when the Fed has clearly been pumping liquidity into the market?
Yes, fortunately, all right, to answer the first question, yes, the role of the bond market, there's a term called financial repression. The central banks, or the authorities, let me not just say just the central banks, but in a financial repression world, they will literally force investors to buy it. I mean, there is no logic buying a negative yielding bond. But for instance, a perfect example of financial repression, Basel rules on banks that we must hold X percentage of government bonds against all our loans outstanding. So we get forced to buy those bonds, notwithstanding the yield. So it's actually got nothing to do with a view. Prescribed assets is which is a hot topic currently in South Africa. That's another example of a financial repression. So yes, whoever asked the question, you're 100% right. It's a very, very, can I say, poor decision to buy government bonds at these very low rates. But unfortunately, the investment community is going to get forced to fund the rest of society with this very, very low interest rates. And the second question was, Avi?
Yeah, so I mean, if money supply is a source of inflation, why aren't we seeing it in the US?
All right, so that, as I mentioned earlier, in this very well-developed financial system, unfortunately for the viewers, I don't have time today to go through that, how the whole debt system has evolved. Traditionally, we had from M0, which is the monetary base, up to M3, that's broad money. But since the 1980s onwards, and especially since the middle 90s when we abolished the Glass-Steagall Act, the whole credit mechanism moved outside the banking, and they call it, we used to call it shadow banking, now we call it non-bank lending. That developed, so there are a monstrous amount, as I said, 400 and something trillion dollars of debt outstanding. So the contraction in that total pool of credit and the shadow banking activities and all that stuff, that counters whatever the Fed is pumping into the system. And Bernanke knew this very well. That's why he went so aggressively, and now Powell understood it as well with the COVID crisis. They know exactly that this contraction in the total pool of money supply. So you have to look at broad money and all the shadow banking activities vis-a-vis the change in the monetary base. The monetary base in the first world is less than 10% of the total money supply, and that's why it has got a very small effect. In Zimbabwe, Venezuela, it is a very much cash-based economy. So the moment you go and pump money into the system, you create inflation immediately. It's an immediate debasement, but it's not the case in the developed world.
Walt, anything from your side on that point?
No, I agree 100% with Neels. I think it's to a large degree the structure of the economies, where cash just plays a much smaller role than it used to, certainly in the 60s and 70s. And absolutely, it's also a case why you can get hyperinflation very easily in places like Venezuela and Zimbabwe, but not elsewhere.
Yeah. Okay. The next question I'll probably put to Walt first. Inflation erodes liabilities and increases asset values, while deflation does the opposite. And hence, deflation is really dangerous for balance sheets. Is that a fair assumption? Deflation
is really bad for balance sheets. Absolutely, I do think it is, and it skews it towards the liabilities. So I think that's a very fair assumption. And if you kind of want to put it through towards, well, I think governments in general, but specifically South Africa, the risk that South Africa runs at this point, at least in my view, with the rising debt of national debt, is that government at some point will be forced to create higher inflation. I don't think it's going to happen, but that risk is building if the debt level is not contained. And it's not something we think about in a kind of a 2 to 3 year view, but more kind of a 5 to 10 year view. Because absolutely, higher inflation deflates debt away. It comes at a cost, and it comes at the cost of your pension funds, the savers who actually hold that debt. Yeah, I'll stop there.
Neels, I'm going to put this one to you. There are a few questions, and I'll probably put all of them together, but most of them are focused around gold. You mentioned at the start of the chat that the reserve currency of the world had changed, and precious metals and gold was one of them back in the day. Is it possible that we go back to that type of standard, or a slightly less aggressive way of asking it, is gold a legitimate alternative store of wealth?
Well, what gold has in its favor is the fact that it's got this 2,000-3,000 year history as a type of currency. Gold is not the normal commodity like copper. It is more currency than it is a commodity. And for traditional reasons, people always run to gold as a store of value. I really doubt, that if we will really go back on a gold standard. But if the central banks start becoming, can I say, if they are successful in creating inflation, yes, that will open, the upside for gold, and gold can go up quite dramatically. But as I've mentioned many times before in this talk, it is far harder to create this inflation in the developed world than most people think it is. In Canada, the central bank's balance sheet is already, I think, 400%. And I just want to go and double check that number. I read it the other day. It's hard for me to believe, but in Japan, it's 120%. In the Eurozone, it's 60%. And the Fed's balance sheet is only 34%. So people always talk about America is going to create inflation with the money creation, yet the Fed is actually the smallest of the major central banks, their balance sheet. So yes, but eventually I think gold will go up dramatically once they start becoming successful in creating inflation.
Thanks, Neels. Here's someone that maybe disagrees with you a little bit. Why does the SARB not finance the fiscus directly, especially given the fact that the biggest risk to a country is debt that is not denominated in the country's currency? Japan is probably the best example of this. My view is that money supply cannot cause inflation, especially if the velocity of money has dropped dramatically. Money supply and velocity work hand in hand.
I would assume that's for me. That is exactly why we don't have inflation anywhere in the world, because the velocity of money, the money that the central banks are pumping into the system, is stagnant. For instance, the last 3 trillion the Fed has printed hasn't even left the Fed. It's still at the Fed. It's not being used in the economy at all. So if people believe we're going to print ourselves out of trouble, and I guess we might still get to the MMT experiment, somebody just must give me the example where in history we have ever printed ourselves out of trouble. If printing money is so successful, why did we bother paying taxes? Yes, I do believe, I buy the story. It's exactly my view. There is no velocity. That's why we don't have inflation.
Thanks, Neels. And so this question goes into tech, and I think it's something that we've chatted about. If tech entrepreneurs are creating value by using technology in every industry, then technology should be driving prices down exponentially across industries. Would this mean that central banks are effectively fighting against the technological advancements using industrial age policies of inflation targeting? Does this mean more and more stimulus and asset prices that do not reflect value? Maybe I'll go to you on this, Walt.
Yeah, so I mean, if you think about technology, and I mean, not necessarily only tech, if you think just technology in general, in the broad sense, whether it is industrial policy technology or industrial technology or kind of fintech technology, etc., it definitely reduces the cost of production, i.e. if you think about it from a demand supply perspective, it increases supply. You can produce more for less. So it is deflationary. I agree 100%, no doubt in it. And on top of that, you also have production increasing, which obviously is even more deflationary. And then the third function that we see, and I think that's certainly something that's going to grow because of this technology, is you increase in general also the supply pool of skills across the globe, and like we currently see, where you're essentially going to have access to a lot of services, especially that sits anywhere in the world. So it increases competition, and all of these forces are deflationary, and the central banks are fighting against it. And it is that's one of the reasons why it's tough, apart from demographics. Do we? And that's also one of the reasons, in South Africa, we talk a lot about, the exchange rate pass through, and why is a weaker exchange rate not resulting into the high inflation that we used to see 10 years ago? And I'm a firm believer part of that is because, we've got this increase in technology, which makes foreign products cheaper, or at least the pass through is less than it used to be. And that is one of the reasons why, if I take a 10-year view, I do think that monetary policy will change. As I've mentioned, I think we're moved towards something maybe like a nominal GDP targeting as opposed to inflation targeting. And also, I'm a firm believer at some point, especially in DM, we're going to see stuff like, modern monetary theory, and where fiscal policy becomes a dominant policy with the help of monetary policy.
Thanks, Walt. Just looking through some of the questions coming through. This is an interesting one. I'm going to put this to you, Niels. What can we as millennials do to adequately plan for retirement in 50 years' time?
Well, at 50 years' time, you don't have to worry. You've got lots of time on your side. It's more the back end of the baby boomers is starting to retire now. As I said earlier, that's got a problem. This cycle will blow over. Once everybody wants inflation because we believe it is the solution to the credit problem. You're going to hate it when it arrives. So there will be a lot of trading opportunities. I do believe that the world, is because the world is so highly geared. It's going to be a very volatile world, and I actually believe that every portfolio should have volatility in it. As much as the central banks try to compress the volatility through by compressing the risk premiums, unfortunately, you can't compress volatility. It's just not logic. And I actually do believe there's going to be an awful lot of trading opportunities for the new generation. So they should not be too concerned. They must just adapt with the changing environment. And we're not going to have these long cycles. I think they're going to be faster and sharper. So there's actually a lot of opportunities. So they should not see it as a threat.
Oh, good to hear. Thanks, Niels. And maybe to put this one to Walt, why is the CIB not able to finance government directly through participating in the primary auctions and forcing yields down when they were able to buy in the secondary market?
Yeah, good question, right? I think it's more just a case of transparency. If the CIB wants to participate in the auctions, everybody would know exactly where they buy and what they buy. As opposed to in the secondary market, it's less transparent. And obviously, the CIB doesn't want the market to know exactly what they're doing, because then everybody will just generally front run. That would be my explanation of that. And obviously, in general, I also don't think, as Niels has mentioned, the CIB should in any case fund the government spending through money printing, because effectively that's what they're doing. Because exactly, as Niels has mentioned, if it was that easy, you can't, everybody would have done that, and you can't, like they say, you can't tax yourself rich. And you certainly also can't print yourself rich. That has never happened before and probably will never happen in the future.
Thanks, Walt. Niels, I'm going to go to you here. I think we've touched on it before, but maybe just to tighten up the message. Can central banks, particularly the Fed, continue to increase the size of their balance sheets? Surely the debt has to be repaid.
That is the one thing we've been struggling with forever. In 2011 already, we brought out Richard Koo from Japan on this whole topic of balance sheet recessions and how do we ever get rid of these balance sheets. I wish I knew the answer to that question because it will help us. But eventually, if you ask me my personal opinion, yes, we will just write off that debt between the central bank and the treasury. So, but you can only do it, for instance, in Japan, where it's all in the same currency. And that's the original sin. That's where a lot of emerging markets get themselves into trouble. If you take on a lot of third currency debt, you can't print that away and write it off. But if it's all in your own currency, yes, you're going to write it off eventually. But that is the ultimate debasement of money that will lead to inflation, which is the ultimate tax on society. So it's not going to come without a cost. You're going to lose the purchasing power of money. And unfortunately, if you study this 800 years of inflation, deflation cycles, once you start debasing money to that extent, it tends, unfortunately, it leads to wars and revolutions, and that's the last place we want to end up in.
I'm going to go last one before we have a few closing comments here. What would the world have looked like if the Fed had not intervened with stimulus? Would we have recovered quicker? Who wants to take that one?
Okay, so as I said, that's what happened for 800 years, or at least let's start from the industrial era onwards, from the 1400s, and when we had fractional banking. And that's why we created central banks, to stop this absolute implosion of the debt cycle. The average drop in asset prices over that last 600 years, if you had that absolute meltdown in debt, was 85% loss in asset prices. So that would have been more or less the consequence, and that's what happened exactly in the Depression. Asset values dropped in the region of 89%. That would have been the cleansing of the system. Yes, we would have recovered much quicker, but it would have been extremely, extremely painful, and that's what the central banks are trying to avoid.
Thanks, Niels. I think we've got a couple of minutes left, so I'm going to close it here. I think first I'm going to go to you, Walt. Just closing comments on your overall views, a reminder of your view on inflation versus deflation. Maybe talk about it from a domestic perspective, and then what does that view mean for the South African economy, and what does it mean for assets in SA?
Sure. Yeah. So I mean, from an SA perspective, I think we shouldn't be worried about deflation. We've gone through, the economy has contracted by, we think, going to contract by 9.4% this year, and we still had inflation, which I think has got to tell you how entrenched inflation generally is in South Africa. Going ahead, we think that inflation will continue to average just below 4%, just below 4.5% for the next 2 years, going into 2021, 2022, which is great from a central bank perspective. It means that they succeed. It actually also means that interest rates can remain low, and that is good. And for me, then, if you think about asset prices in general, as I said, ultimately, I think this, and it might not feel like this now, but I do think these things tend to transpire eventually. It will lead to higher hard asset prices in South Africa, at least from current levels. It's an ideal situation where, for example, I think property markets should and housing market should flourish. That's the asset price perspective. Growth, unfortunately, in general, I think will remain too low to see a substantial rise in other asset prices. I think demand in general in the economy will continue to struggle. We think that growth next year will be 3.2%, but that is mainly because the base is so low this year. It will actually still feel very much like a recession, and ultimately, South Africa's growth is still around about 2% in our view. And the last point which I'll make is in terms of asset prices. We do think that in terms of, you think about the bond market and you think long term, as I said, I think the risk is starting to build if you take a 5 to 10 year view, where the government cannot afford to have low inflation. And when I say low inflation, I talk about 3-4%. And ultimately, we'll have to, the pressure is going to build to run higher inflation, to deflate the debt away, as Niels has mentioned. Certainly not something in the near term, but I can see that pressure building longer term.
Okay, so pressure on to get inflation back. Asset prices should hold up okay to increase from here. Niels, I'm going to leave you with the last word. You're quite clear on the deflation theme. What does this mean?
So I expect nominal rates to remain very low. The problem is, in a deflationary environment, your real rates go up. And that is, for instance, why you struggle to grow out of it, because although you keep rates at zero, your nominal rate, your real rates actually remains very high, and that's one thing Japan has never been able to get right. So we're already paying the price for high real rates because in our economy, because what is deflation? Deflation is a contraction in money supply, and the weak balance sheets are going to pay up to get that money, and that's already very evident in our yield curve, and our SA Inc stocks have struggled because of that quite dramatically. So Walter and I agree 100% of that, that we can have this low growth, low rate environment. One other thing that's starting to worry me is that the more we move away from monetary policy, I'm talking to the developed world now because they realize it's very blunt now. They've pumped $25 trillion of monetary base into the system around the world, and they still have not achieved any inflation or growth. They're going to move more and more over to fiscal, and Walter and I agree with that. But I'm very concerned what happens to the carry trade, because traditionally when the first world flooded the world with money, inevitably the carry trade will pick up and that money will start chasing yield, and South Africa would get some of that. So I think that source of funding we used to get from the first world central banks is going to dry up more and more, and there's a lot of pressure on the local fiscal authorities to live within their means, otherwise they will pay a price for that. But as I said earlier, when you're asking about the 25-year-olds mostly, I think there's going to be a lot of shorter, very volatile cycles that we must try and catch in the investment game.
Awesome. Keeps it very interesting for us. Guys, thank you so much for your time. It's always a pleasure talking to both of you. You're a wealth of knowledge. Thanks so much for sharing it. To the audience, thanks very much for dialing in. Thanks for all the questions that have been sent through to us. And we'll see you soon. Cheers. Bye.
Cheers.